Welcome back, everybody. As 2024 ramps up, there's no shortage of hot takes online. And we're going to talk about a couple of them today. The first of which, words cannot express how I feel about the first one, but I'm going to try. In today's video, we're going to talk about the growing tax narrative that could be really bad for investors, as well as the hot take about how streaming services are just like cable again. And we'll wrap up talking just a bit about what the recent tech sell-off to start 2024 actually means or doesn't mean. So let's get started. So I haven't really been tweeting a lot lately, but when I do and I call something probably the dumbest thing you'll read today, I think you know how strongly I feel about it. The Americans for Tax Fairness, which I'm not sure if this is a legit organization or just a group on social media, but they tweeted out this thread. And it says, billionaires and centimillionaires held $8.5 trillion in untaxed, unrealized capital gains in 2022. Unrealized gains are the largest source of income for the ultra-rich, but they're completely untaxed under our tax code. And this is why we need a billionaire income tax. Now, I just want to start off by saying that I don't really do the political thing. Like, if you watch my channel, you've probably heard me say that I don't really align with any political party, and I think most politicians are terrible and don't actually help people. So the comments that I make about this tweet aren't political at all. I just want to talk about this idea of taxing unrealized gains and talk about why it's pretty terrible. But if you're watching this channel, I'm guessing you already know that. But let's dig into it anyway. So first off, it says unrealized gains are the largest source of income for the ultra-rich. Now, the problem with this, of course, is that if you invest in stocks or ETFs, you already know unrealized gains aren't actually income because they are, by definition, unrealized. So just because the stock you bought went up 10% yesterday doesn't mean that you put that 10% in your pocket. I mean, it could go down 11% today, and then you're down 1% overall. Now, of course, you guys know this. It's some of the most basic concepts of investing. So the whole idea or argument is made off of a false statement to begin with. But unfortunately, the Americans for Tax Fairness isn't the only group that wants to do this. Elizabeth Warren has talked about taxing unrealized asset gains, and a portion of that language is part of Joe Biden's tax proposal. And in general, it would work something like this. You'd have a total income that was calculated, and for tax purposes, it would be calculated to include unrealized capital gains. That total income above a threshold would automatically be taxed at a certain rate. And if you don't have the cash to pay the increased tax, you may have to sell assets. But then if your assets decline in value, basically unrealized capital losses, you don't get to deduct those losses. You would just owe less tax that particular year until they actually rise again, and then you pay more again. Now, this makes no sense no matter how you spin it. And it gets especially more complicated if your net worth is tied in ownership of an actual business where you can't really liquidate shares very easily. Now, his proposal says it's only for households with an accumulated net worth of over $100 million. So regular everyday investors like you or me probably wouldn't be impacted. But the problem is that if anything like that actually gets passed, then it's relatively trivial to change the threshold. Maybe not on a whim, but pretty close. I don't know how likely something like this is to ever get passed, but I assume that it's going to be something that is going to be talked about on an ongoing basis, especially as the U.S. enters an election year in 2024. But I wanted to quickly go through the rest of these charts just to show you something that I think is important. Now, the next one says, billionaires and centimillionaires now hold 700% of the amount of unrealized gains that they held in 1989, and it shows here this growing amount of unrealized capital gains. Now, what this diagram is actually great at showing is the reason why investing is important for people. Because the reason why it's up 700% since 1989 is mostly due to the increase in money supply. Because if we look at the M2 chart, we see that in 1989, it was around $3 trillion, but now it's around $21 trillion. See, the increase in money supply inflates the price of assets, which is why it's so important for people to invest. Most of that 700% could be tied directly to the similar increase in money supply as much as anything else. So if we really want to help people, we would continue to be teaching them why it's so important for them to invest so that their own net worth can grow as the money supply grows. And the next couple images are the same idea. You have the share of unrealized gains, and it's grown because, again, if you hold stocks or other assets, you've benefited from the increase in the money supply. And if you don't own assets, then obviously you haven't. And then this one about property versus financial assets, again, this is the same issue. Most people's only asset is their home. So people who have stocks and other investments are going to benefit more than people who only have an investment asset in their home. But to me, when I look at this, it comes down to something very simple. The difference is people who invest versus people who don't invest. And there can be a myriad of reasons why someone doesn't invest or can invest. But at the end of the day, that is really the difference. And that's why, as dumb as this tweet thread is and this general idea, it's the best possible advertisement to show why investing is so important. Because the difference in every single one of these charts is one group is investing and the other isn't. Now, politicians on both sides will say whatever nonsense they think is going to resonate to get a vote. But the reason why I say financial independence is true freedom at the end of all my videos is because financial independence makes it to where we're not dependent on these politicians for our family's well-being. And I think that's where everybody, at least on some level, should strive to be. Okay, so I wanted to switch gears a bit and talk about streaming services real quick, because I've seen this meme or idea in a lot of places online about how streaming is now just like cable. And what have we done? We've gone right back to the cable mess, and now it's even on news clips as well.
A new report from the Wall Street Journal finds significantly more Americans are starting to hit the cancel button. That could be good news for your money in unexpected ways. Joining me now is Sarah Kraus, Los Angeles bureau chief for the Wall Street Journal. I personally think part of it is they have those new services that say, hey, did you know how much you're really paying in subscriptions? And when you look at it en masse, you're like, wait a minute, I haven't watched HBO in a year. Why am I still paying for that every month? Sorry to call out HBO, but it was true. So I canceled. Sarah, your turn.
It's true. I think more Americans are looking holistically at what they're paying for their streaming services. And what started as a relatively low bill in the early days has slowly and steadily ballooned to the point where people are saying, you know what, we're actually getting closer to what the cable bill was. And we hated that. And we went to streaming because it was cheaper, and now it's not. So what you really see is more households being strategic about what they use and turning services on and off. So some customers that have canceled are going back, but they're being much more strategic about it. So really what the streaming platforms are up against are much savvier consumers who are using the flexibility of streaming, the ability to turn it on and off to their advantage.
Well, and I actually think that this specific point that she brings up is really great, because the only reason that this is even a possibility is because streaming allows it. You don't have one-year contracts or cancellation fees and no all-or-nothing type service that basically means you either pay us over $100 a month or you need to go back to your rabbit ears. And for those of you that are too young to know what that is, they're those little antenna on the TV when you try to get a signal without cable.
I can do better with my rabbit ears.
So what people are really missing is that, yes, the total cost, if you have a handful of streaming services that you're paying for, may end up being as much as cable. But what's different is that you don't have to have a handful. You can have one or three or none. Like next month, your favorite show might end and you can actually cancel. When it comes back in 2 years, you can start up again. And most of the time, it's as simple as clicking a button on your app or on a website. And you can't tell me that that's not better than cable. Way higher value, and to me, it's not even close. But as it relates to streaming stocks, a lot of them really aren't doing very well. So Paramount's down over 20% in the last year. Warner Brothers, which is Max, is up, but only slightly. And then obviously Amazon and Apple are major players as well, but it's a smaller part of their overall business. And then there's Netflix.
I have two questions. One, is anybody canceling Netflix? Is that the one that's being canceled, or is it the other additional ones that where you were like, oh, $3, $5? Okay, it turns out that I don't actually need that.
It's a good question. So Netflix has typically had the lowest rate of customer defections in the industry, and that continues to be true. So even though they did the password crackdown, even though prices have gone up, their churn has remained relatively stable and far below their rivals. So I've heard from some users who have said, you know what, I downgraded to a less expensive Netflix plan, or I chose an ad-supported plan to bring that bill down. But far fewer Netflix customers are actually canceling. And that is actually one of the strategic coups for them over the last year, really, is getting that password sharing crackdown right, such that few customers are heading for the exits.
Okay.
And Netflix has absolutely crushed it over the past year, and that's with cracking down on password sharing and even increasing prices. And it goes back to this idea of overall value versus cost. Now, Netflix has a great library of content that they've done a good job of mixing their own originals with popular licensed movies and shows. And in my opinion, what they do best is they have a variety that hits everybody in the family equally. So to me, that's where their value proposition was created early on. You pay $15 to $20 a month, and my kids always have something that they want to watch that they're interested in on just about any device. To me, that's extremely cheap, and it's not even really a question. And the fact that there's a bunch of content on there for me as well whenever I want to watch is just a plus. Now, with other services, I don't think their value is as clear-cut, even with Disney. They have a lot of great shows there, but obviously it skews more towards the kids only. But even then, I don't think they have the level of variety that Netflix has, even for kids. So I think that's why Netflix tends to be the one people stick with, even if they plan to churn with the others based on whenever the new shows that they like actually come out. Now, I will say, for me, I do think there are others that have great content. Like Apple TV Plus is super underrated in my opinion. They don't have nearly the amount of content that the others do, but their originals like Severance, Ted Lasso, and Shrinking are all excellent, excellent shows. But comparing the value that we get with any of these services to what cable and dish used to be like is insane to me. Like just with one service, it gives you access to thousands of shows and movies and their full catalogs anytime you want to watch them. You never got that with cable, and definitely not for $20 a month. All right, so last topic for today. I'm beating the market ever so slightly after the first market week of the year, but as I mentioned, we're still negative. And that's prompted a lot of people to ask, what is actually going on out there? Of course, like always, it's mostly overreactions because markets go up and down all the time. But I thought this clip from Josh Brown was excellent.
So 2 days of red in a row. I said we had some buying of mega caps. You had to believe at some point investors are going to look at declines in those stocks and say enough's enough. Enough is enough. The best stories in the market, and those are the best plays still.
So I agree, and we talked yesterday on The Half about just like why are people selling? Obviously, nothing fundamentally changed. People have massive gains in these stocks, especially if they held them through the fourth quarter. And if they did that and they were waiting for an opportunity to take the profit, I'm on the wealth management side, so I already know the way financial advisors think, the way high net worth investors think is, all right, we're going to take 10% off the table, but why would we do it in this fiscal year and owe the taxes in April? Let's push that decision a little. Let's push that tax liability a little bit further out without taking significant risk. This first week of January, after a massive, very sector-specific rally in the market, makes perfect sense to see profit taking. I also think there's a lot of rebalance activity. You combine those two things on the scale of trillions of dollars, that's how you get these stocks start the year looking like they're stumbling, but really, fundamentally, their businesses are not stumbling.
And this, to me, is the most logical and reasonable explanation. It makes perfect sense for folks to lock in some gains from the past 2 months, but wait until the 2024 tax year to do so. Just like people tax loss harvest in December to help their taxes in April, they tax gain harvest in January to lock in some of their profits, but delay any owed taxes until the year after. Now, ultimately, like he said, nothing has really changed with these businesses. It's just normal investor actions and market movements. And when it comes to big tech and the mega caps that have kind of ruled the market, everybody's kind of wondering what to expect in 2024. Well, let's listen to Josh Brown again.
The point is clear. These stocks went up the way they did for a reason, and they're going to remain in favor for a reason.
Look, I happen to think Alphabet and Amazon are two of the best stocks to own for this year. I don't love the valuation. Do I wish they were 10 turns cheaper on PE? Of course I do. But these are the cards in front of us, right? We don't always get to pick. I think these stocks will be very stable this year. I don't know that they'll outperform everything in the way that we saw big cap tech last year outperform everything. But I think they can work because they are two of the biggest beneficiaries of AI. This is the year that AI goes from a concept to an actual product. Microsoft's got an early lead, but I think when you look at the ownership of Anthropic, you look at Amazon now using their own chips to train large language models, you look at Alphabet's opportunity to incorporate these tools into all of their existing products for literally hundreds of millions of people on day one. These are companies that are going to benefit, and I don't think they're so expensive that we have to look past them on a valuation basis. So maybe it's not as great of a setup as it was last year. I still want to be there, but I want to be in other places too. And I think you don't have to choose. You can do both things at once. Energy got off to a great start this year. This is the third worst performing sector last year. This year it's in the lead. XLE plus 3%. There's no reason why that couldn't continue, and actually crude caught a bid today. So there are other things to do. It's not Amazon or energy, in my view. It's Amazon and energy. I think you want to look all over the world, quite frankly. There's a lot of value elsewhere.
Now, first off, I really love Josh Brown's perspective here. It's not either or necessarily. It can be and. And if you guys have been on this channel for a while, you hear me say those type of things a lot. But I think there's multiple things he said here that are interesting. He said energy looks good from a valuation perspective and probably poised for a rebound. And for me, I had Valero in my top 4 for 2024 list, specifically for that reason. He talked about big tech valuations may be high, but they're still the best companies out there. Just not sure if they're going to actually outperform the market or not. And I had a similar view about Apple as well. I think it has a chance to beat expectations on earnings this year as the COVID year comps go away and services continue to grow. But I left it off my top 2024 list because they're at about a 30 PE with some growth concerns, and I think they might be due for a year of multiple compression. Ultimately, though, Apple is still one of the best companies in the world to me, so taking advantage of material dips is going to be key. And I was excited to see Brad Gerstner talking about Apple a little bit on Twitter as it relates to AI. And hopefully we'll get to hear something about that in 2024. If we do, then I think there's a chance that it continues to outperform as the market realizes that Apple, in fact, isn't behind in AI like they keep saying that they are. And if you've been watching this channel, you heard me say something similar way back in July of last year when I bought Apple at the top. It would allow them to have the tightest and hopefully most seamless integration of AI features into the place where it can actually become a value add in our daily life. So we'll have to wait and see if that actually comes to fruition or not, and if we actually hear about it in 2024. Either way, I'm obviously still holding on to my Apple position and actually added to it last week as it dipped. So do you guys have any predictions of what we might see in the market in 2024? Let me know down in the comments below. Now, if you're interested in more commentary about markets and stocks with some random personal anecdotes sprinkled in, click on this link right here to sign up for my free weekly newsletter and get them sent straight to your inbox. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.